All right, so let's jump right in. We're taking a deep dive today into this market deep dive report from December 18th, 2024. And it breaks down a day when the major U.S. indices, well, they all took a bit of a hit. Dow, S&P 500, NASDAQ, you name it. They were all showing red arrows. On the surface, it might look like just your typical, day of market jitters, but
Yeah.
trust me, there's a lot more going on here.
Yeah, and this report actually starts with what might seem like kind of a non-event. The Federal Reserve held interest rates steady. Big surprise, right?
Yeah,
I mean, analysts were expecting that.
exactly. But here's where things get kind of interesting. The report highlights that the Fed is projecting 3 rate cuts in 2025. So that throws a little bit of a curveball into things, almost like they're hinting at hitting the easy button on the economy a little bit.
Yeah, it's definitely a shift in tone, I think. For months, the narrative has been all about, raising rates to fight inflation. And this projection kind of suggests that maybe the Fed is a little more concerned about a potential economic slowdown than they're letting on.
So are we reading between the lines here? I mean, is this like a subtle signal that a recession is looming and they're trying to get ahead of it?
It's too early to say for sure, but it's definitely a possibility. And I think that's why this seemingly, mundane news about holding rates actually kind of sent shockwaves through the market.
Makes sense. And speaking of mixed signals, the report also digs into some of the economic data that was released that day. Retail sales were up, which indicates that, consumers are still spending. But aren't we trying to cool inflation? Doesn't that just add fuel to the fire?
Well, it's a bit of a tightrope walk for the Fed, right? On the one hand, strong consumer spending is good. It's a good sign for economic growth. But on the other hand, if demand stays high, businesses can just, keep raising prices. And that keeps inflation going. So the Fed is in this tricky spot trying to balance growth with price stability.
Okay, well, let's break down how different sectors reacted. Because the report shows a pretty interesting mix. Tech surprisingly held up relatively well, especially semiconductor stocks. Micron in particular had a stellar earnings report, which we'll dig into a little bit later.
Yeah, and what's fascinating here is that tech is usually pretty sensitive to interest rate changes. So the fact that it didn't completely tank suggests that investors might be looking past the short-term rate fluctuations and betting on long-term growth, particularly in areas like AI.
AI seems to be the magic word these days.
Mm-hmm.
And speaking of consumer spending, the consumer discretionary sector also performed well, probably boosted by those strong retail sales numbers we were just talking about. But then, on the other hand, energy struggled with oil prices taking a dip.
Yeah, and that dip in oil prices suggests that, maybe concerns about global economic growth might be creeping in. If the global economy slows down, demand for oil drops, and that puts downward pressure on prices. It's just classic supply and demand playing out on the world stage.
Okay, so let's get to the juicy stuff. The report highlights some major stock-specific movements that I think our listeners will find really interesting. First up, NVIDIA had a strong rebound. Is this a sign that the AI-driven growth story is back on track?
Well, NVIDIA's rebound is definitely something to watch. I mean, they're a major player in the AI space, and their performance could signal renewed confidence in their ability to capitalize on the growing demand for AI-related chips and technologies. But it's not just about NVIDIA. Think about the bigger picture, the companies that supply the raw materials, the software developers, the businesses that are integrating AI into their operations. NVIDIA's success could have ripple effects throughout the entire AI ecosystem.
It's like a rising tide lifts all boats. But in this case, the tide is AI. And then there's Micron, which saw its stock jump in after-hours trading, thanks to strong earnings and guidance, driven, of course, by that AI-fueled demand.
Yeah, and Micron's performance really reinforces that AI narrative. Their strong earnings and guidance suggest that companies are investing heavily in AI infrastructure, which creates a huge opportunity for Micron and other companies in that space. This isn't just a blip on the radar, it's a sign of a potentially long-term trend.
But it's not all sunshine and rainbows in the market. General Mills had a rough day with their stock dropping after they lowered their earnings forecast. What's going on there?
Well, this seems to be more of a company-specific issue than a broader sector trend. The report mentions that General Mills pointed to, a challenging consumer environment, which could mean that they're feeling the pinch from, rising input costs or shifts in consumer spending habits. It's a good reminder that even in a strong market, individual companies can still face headwinds.
Right, not every stock is going to be a winner.
And then there's Ollie's Bargain Outlet, which hit a 52-week high after getting a double upgrade from analysts. What's their secret sauce? Well, Ollie's success might be tied to their focus on value, in an environment where consumers are becoming more price conscious. Their model of offering, deeply discounted merchandise could be resonating particularly well right now.
Makes sense. And finally, we can't forget the entertainment giant Disney. Their stock climbed after a positive analyst prediction. Is the magic back?
Well, Disney's stock performance is certainly encouraging, but it's important to remember that, analyst predictions aren't exactly crystal balls. However, it does suggest that, at least some analysts are optimistic about Disney's future, perhaps due to factors like, their streaming services, their theme parks, upcoming film releases. It's all about how they leverage their assets and navigate the evolving media landscape.
Right? A single analyst prediction doesn't tell the whole story, but it's definitely a piece of the puzzle. Now, let's shift gears and talk about the bond market for a second. The report explains how bond yields reacted to the Fed's news. But I think it would be helpful to take a step back and explain what bond yields actually mean, especially for our listeners who might not be, bond market experts.
Absolutely. In simple terms, a bond yield represents the return an investor can expect to receive from holding a bond until it matures, and bond prices and yields move in opposite directions. So when bond prices go down, yields go up, and vice versa. And they're often seen as kind of a barometer of investor sentiment about the economy and future interest rates. So in this case, the report mentions that the yield on the 10-year Treasury note, which is kind of a key benchmark, initially jumped but then settled lower.
Okay, so what does that tell us? Was the market initially spooked by the Fed's hints at future rate cuts and then kind of calmed down?
Yeah, that's a very astute observation. That initial jump in yield suggests that some investors might have been worried about the potential inflationary effects of the Fed's more dovish outlook. However, the subsequent decline indicates that maybe those concerns were outweighed by the belief that the Fed's actions could ultimately support economic growth in the long run. It's a delicate balancing act. And the bond market is definitely reflecting that uncertainty.
Interesting. Now let's take a quick look at the commodity markets. The report highlights that oil prices were down, and it links that to worries about global demand. What's driving those concerns?
Well, oil prices are highly sensitive to global economic conditions. Any hints of a slowdown in major economies like China or Europe can lead to lower demand for oil, which puts downward pressure on prices.
And the report also mentions that gold saw a modest increase. Is that the classic safe haven play we see when there's uncertainty in the market?
It's certainly possible. Gold is often viewed as a hedge against inflation and economic uncertainty. So when investors get nervous about the future, they tend to flock to gold as a store of value.
Makes sense. And lastly, the report notes that copper prices were up. Could you connect that to the Fed's potential rate cuts in 2025?
Absolutely. Copper is considered a bellwether for economic health because it's used in so many industrial applications. So if the Fed does indeed cut rates in 2025, it could stimulate economic activity, leading to increased demand for copper and other industrial metals.
So it seems like the commodity markets are sending mixed signals as well, reflecting both optimism and caution about the future.
Precisely. There are both positive and negative signals to be found in the commodity market data, and it's up to investors to interpret those signals and make informed decisions.
And of course, the Fed's influence extends far beyond U.S. borders. The report briefly mentions global market reactions, noting that European markets were down while Asian markets were mixed. Why does the U.S. Fed matter so much to the rest of the world?
Well, the U.S. is the world's largest economy, and the Fed's decisions have ripple effects throughout the global financial system. When the Fed adjusts interest rates, it affects the cost of borrowing for businesses and consumers worldwide.
It's like the U.S. sneezes and the rest of the world catches a cold.
That's a very apt analogy. The global economy is so interconnected that events in one country can have significant impacts on others. And the Fed, as the central bank of the world's largest economy, plays a pivotal role in shaping those global dynamics.
Okay, so let's wrap things up by looking ahead a little bit. This Market Deep Dive report has a section I love. It's called Looking Ahead. And it just lays out some key questions that investors should be thinking about. So let's turn those into questions for you, our listener. First up, will other central banks follow the Fed's lead on these potential rate cuts?
That's the big question. I mean, each central bank operates within its own unique economic landscape, right? Some might prioritize taming inflation even if it means slowing growth, while others might be more focused on stimulating their economies, even if it risks a bit more inflation. It'll be interesting to see how this monetary policy divergence plays out in the coming months.
And what economic data points should our listeners be keeping an eye on? What are the clues that'll help them decipher this economic puzzle?
We'll keep a close eye on those classic economic indicators. Inflation reports, employment data, GDP growth figures, these are the vital signs of the economy. And they'll give you a pretty good sense of where things are headed. And they might even give you some insight into, the Fed's future moves. But don't just focus on the U.S. Pay attention to global economic data as well, especially from major economies like China and the Eurozone.
Speaking of looking ahead, corporate earnings season is coming up.
Hmm.
What will companies be saying about 2025?
Well, earnings calls and guidance statements are like gold mines of information. Companies will be sharing their outlooks, giving you glimpses into their expectations for growth, profitability, and the overall economic climate. So listen carefully to what they're saying, not just about their own performance, but about the broader trends they're seeing in their industries.
Right. It's all about reading between the lines and connecting the dots. And we can't forget about the geopolitical wildcards out there. How might those impact the markets in the near future?
Yeah, geopolitics is the ultimate wild card. Trade tensions, political instability, even armed conflicts. These can inject a huge amount of uncertainty into the markets. They can impact investor sentiment, disrupt supply chains, lead to significant market volatility. It's a good reminder that investing isn't just about numbers, it's about understanding the world around us.
And finally, let's talk about two big picture trends that we've seen, dominating headlines lately. AI and technology and consumer spending. Will AI continue to be the driving force? Or will something else steal the spotlight? And will consumer spending remain strong, or will inflation anxieties start to take hold?
These are the million-dollar questions. AI and technology are transforming industries at a breakneck pace, and that innovation isn't slowing down anytime soon. But it's also wise to remember that, no trend lasts forever. New innovations emerge, consumer preferences evolve, the market landscape shifts. As for consumer spending, it's a vital engine of economic growth. But it's also influenced by a myriad of factors, inflation, interest rates, consumer confidence.
So it seems like there's a lot to watch, a lot to learn, a lot of potential opportunities, but also some risks to be aware of.
Exactly. Informed decision-making is key. And hopefully this deep dive is giving you some food for thought as you navigate the exciting and sometimes unpredictable world of investing.
I think you're right. We've covered a lot of ground today, taking a deep dive into a single day in the market, December 18th, 2024. But as we've seen, it's just one snapshot in a much larger story that's constantly unfolding.
Absolutely. Each trading day is a piece of the puzzle. And understanding the interplay of these various factors, from Fed policy to corporate earnings to global events, is essential for navigating the markets effectively.